Yeah, I'm not sure there's any tax changes that will necessarily drive whether you go listed or indirect. I mean, or through a transparent vehicle, obviously there's lots of different tax treatments. I mean, there's a lot of sensitivity at the moment about how you assess tax risk in relation to existing structures, because the revenue authorities worldwide are looking a lot more closely at this. There's a so-called BEPS initiative, base erosion profit shifting. So things like transfer pricing, trying to move profits offshore to a lower jurisdiction, asymmetrical agreements where you get a tax deduction in one jurisdiction, not taxed in the other, or artificial structures where you're trying to get the benefit of a treaty but there's no real substance there, or where you're trying to technically avoid having a permanent establishment in a country. All those sorts of things are being looked at closely, and if you sort of model that over an intended sort of whole period of the asset, it's quite difficult to reach a judgment as to what the likely impact on cash flow or exit would be. And we see clients run different models on that, on certain assumptions, but it's very much a sort of a sensitive issue. From the pure regulation side, I don't think there's anything per se. Obviously, Solvency II is an important component and is affecting the market, particularly, for example, in debt, where the sort of treatment of loans originated by insurance companies, etc., is changing, and obviously it's had a big impact on CMBS. I mean, we find, for example, that loans originated by life companies, the capital cost to them of a loan is a lot less if they can so-called match it with their liabilities within the parameters of Solvency II, which is sometimes quite hard to do when you've got an amortising cash flow or different earlier prepayment dates, so then the cost goes up. So we find there's some insurers, sort of Rothschild type people who aren't governed by Solvency II, sometimes sort of cheaper than some of the other insurance companies there. So regulation does affect pricing as well, and it also has certainly anomalous consequences, because obviously there's a lot of regulation on lending, but in reality that's led to a lot of unregulated lenders, through the alternative lenders, and what we quite often find is that a US investment bank will now originate a loan, whereas previously they would then securitise that loan. They now distribute it on to money funds or institutional investors. So the sort of investor base for these funds is a little rarer than it was.